maturity, bond or security with maturity, and we also covered zero coupon bond and deep discount bond. And we calculated, expected rate of return or yield to maturity. So basically YTM is one kind of measure or proxy to compare the performance or yield from your investment. Yield means basically your return. So if you have 5 different bonds, you can think of, one bond with the 5-year maturity, which is, 5-year maturity. Another bond you have is a zero coupon bond with the certain specification. Another bond you have is 10-year bond. So if you want to compare which one is going to provide you high yield, assuming that your investment horizon is around 10 years. So in that case, you can consider YTM as a proxy. Like in case of a stock return, what we use holding period return or some kind of portfolio return to decide which one is the best one. Same way, YTM is one of the proxy. There are various measures. This is one of the measure that can be used to analyze the best option at given at given point of time. Now, so far we have seen relationship. If you remember this kind of relationship we have seen. So here interest rate and bond price. But maturity is also one of the key factor. So based on maturity, your slope of this curve will be decided. For example, if you see for when discount rate is 5%, for 5-year maturity, this is the value, and when your discount rate is increasing, so this is how your value will change. But when it is 10-year bond, so in 10-year bond, if you see the decrease is more than what you have for 5-year. So basically this is slope for this is more. And when we compare all three, this type of bond having high slope. And that slope is coming from where? That slope is coming because of different maturity period. So when we look at this relationship, you can see you have 3 type of bond. So this is the, remember, this is the rate where coupon rate is equal to your required rate of return. And that's why in this case, your present value of bond will be equal to face value. So here you can see thousands. So, and now when we see the slope, you can check that, slope will vary based on what kind of, a bond you are selecting. So if you see this is your 5-year bond, so slope is not steeper. When you compare with a 10-year bond and perpetual bond slope is higher as compared to your 5-year bond. So that tells you the influence of bond maturity on value of the bond or intrinsic value of the bond. So it's not only interest rate. Your bond is not only sensitive to the interest rate. It is also sensitive to your bond maturity. So how we can calculate yield to maturity? Exactly, everything is same. The only difference here is this part is unknown. So this is your unknown, term, which is yield to maturity. So yield to maturity is basically, bond holder, how much yield or return bond holder will earn on a bond if if it is held for entire maturity period. And that's why, your this yield to maturity is basically your expected return. How much return we are calling it expected because, your bond life is more. And that's why when we are discounting it at your, expected discounting at appropriate rate, so that is your expected rate of return or expected return. Or another way, when we talk about debt security term, we call it yield to maturity. How much return you expect or you will get if you are holding a bond instrument till maturity. And this is the case, you remember this is semi-annual payment case. It means your interest is going to be divided by 2 and your these rates, your R is going to be divided by 2. And this is the formula. So this is how your calculation uh, will be. And then and basically this should be here. It should be M. Remember, this should be M rather than 1. M divided by your this value. So this is how. So this is basically present value of your interest that you are going to get, interest income, interest payment, or coupon payment that investor will enjoy over the period of time. And this part is present value of your maturity amount. So here is one problem for 2-year maturity. So you are considering a bond with having face value of $1,000. Bond pays 11% coupon per year, paid semi-annually. Remember, so this coupon is basically your nominal rate or nominal coupon or interest you will in bondholder will enjoy, and this coupon is paid semi-annually. Bond is maturing in 15 years. Face value 1,000. If current market price is this, yield to maturity, how we will calculate. So exactly, so this is basically, remember, interest component. Interest is going to be your face value into coupon rate divided by 2. Why divided by 2? Because this is semi-annual. And here we are going to calculate YTM. So this is unknown entity. And this is because it is going to mature on face value. So this is how we can frame it. And then using trial and error method, we can calculate YTM. But remember, this YTM, whatever you will get, this YTM will be based on your semi-annual. But if in question it is asked, you present YTM in your annual rate, remember, then you need to adjust it. Why? Because it is going to be compounded if you are calculating on annual basis or effective annual return basis. So whatever you will get will be the nominal rate on bond. So you need to consider whether in question it is asked for asked to calculate in annual basis, effective annual return, or just YTM. And there is another shortcut here. If you see, you will get 12.36% as YTM. And there is shortcut as well. But of course, shortcut won't give you, very precise answer. So that's why if you want very precise answer, it is always better that you go for trial and error method and get, some value of YTM, and that when you calculate right hand side, it equates 931.176. So this is how you can go for approximation. So C is the coupon payment. So in this coupon payment is how much? 110 divided by 2. This is F is your face value 1000. Market price is 931.176 and is the maturity period, which is 50. And this is average, face value and market price. And sometimes, in certain textbook or, they follow different, especially if it is denominator part. They, what they do, they give 40% weightage to face value and 60% weightage to market value or market price. And what logic is followed here? It is followed that because market is one of the proxy that captures how price trend will be. So more this is more informative. And that's why 60% information or 60% weightage is given to market price and 40% is given to face value. But this will also give you, in this case, you have 50% of weightage to both. So both will give you, somewhere approximate guess number close to YTM. But you need to verify. Let's say you get, one number here by plugging here this obtained number, whether you get 931 or not. If you are not getting, it means this number needs some kind of modification. So you can, the best way is you use this shortcut to get and guess for this YTM. And once you have this, you change it, modify it based on your number. Let's say if this right hand side is coming 950, you use, let's say, YTM as 11%. It means that there is a negative relationship between this and this. It means your correct YTM will be more than 11%. So if you increase this by, let's say, 1%, this number will come down to, let's say, 41. It means you need to further increase your interest rate, because if you increase interest rate, your present value will come down. Negative relationship. So you further increase by, let's say, 4%. So you may, get this number close to 930 or 931. So this is how you can, combine your shortcut approach and then your guess, or then your further changes to get a correct YTM number. So this is how we have seen that your coupon rate. If your coupon rate is high, remember your coupon rate. How coupon rate will reflect? Coupon rate will be capturing your cash flow. What is cash flow we are talking about? We are talking about interest payment that investor will be receiving. And so basically this will come in your numerator part. So that's why if your coupon of particular bond is high, then it is going to be less sensitive towards the interest rate. Whereas the bond which are having a low coupon rate, their slope will be higher, and then they are going to be more sensitive towards the change in the interest rate. So this is something we should know, especially when you are looking your portfolio variation. Portfolio variation means how portfolio is sensitive towards the interest rate. So coupon, information about the coupon payment or coupon stated on a particular bond, it will tell you how much sensitive your portfolio will be if you are considering that instrument in your portfolio. Now, another proxy that captures sensitivity of bond is duration. Remember, this is not maturity. Duration and maturity are not the same. It may be same, but by definition, maturity is duration or number of time period or years for which a debt instrument is issued. Whereas duration is the, it's a weighted average time to maturity on debt security or financial security using a relative present value of cash flow as a weight. So we will see how we can calculate it and where we are going to use because this is a measure, duration is a measure that relates or that tells you about the sensitivity of bond. So what sensitivity are talking about? We are talking about sensitivity with respect to interest rate. Like yesterday, one student has asked question how your bond is sensitive towards interest rate. So I said that one relationship we already know, inverse relationship between interest rate and bond price. And another measure we will talk later. So your duration is another proxy or a measure that captures the sensitivity of bond with respect to interest rate. And there are multiple uses of duration. So we will see once we calculate the duration when the formula, then it is going to be very clear. And also here if you see the effect of maturity, we know that how effect of maturity and coupon rate change the bond value or present value of bond. So duration basically captures your sensitivity of bond price with respect to interest rate, considering the effective maturity and stated coupon rate. So now here formula is there to calculate duration. So again in duration, your CF is basically your cash flow face value into coupon rate. So this is what we are calling your cash flow. And in this formula, remember in this formula, what we have basically annual, these are the effective interest rate. Means if this is, you can assume that if in this scenario, payments are made annual basis, and that's why there is no adjustment. Whereas here, if you see, this is semi-annual, payment bond. So we are adjusting here for time and adjusting for interest rate. So let's first see formula in numerator. What we have in numerator, if you remember, for particular bond, sigma CFT upon 1 plus R to the power T, T is equal to 1 to N. So, and cash flow, remember, cash flow is what? Cash flow is how much payment you will get. Payment could be of two term. One is maturity value. Another could be your interest component or interest payment. It's based on how much coupon rate is mentioned. So here, so basically this is nothing but your present value of bond. And denominator is also your present value. So what we are doing, and so basically this is the your weight of your present value. So this is the present value in a given time divided by present value of overall bond, and we are multiplying it by time period. Whereas when it is semi-annual, your time period will be half. So it is going to increase by half. Here time period will be 1 to T, 1 to N or 1 to capital T. Here it will go from 1 to 2T. So this is how difference there will be based on frequency of coupon payment. Now let's take this example, and then you will be able to understand how we can calculate duration. So first you see, suppose you have a bond, coupon rate of 10%, paid semi-annually, face value 1000, and maturity period 4 years, and your required rate of return is 8%. Because this is semi-annual, so your coupon rate effect will become 10 by 2. So basically 5. And your discounting factor, right now your required rate of return or current rate of return is 8%. So your R will become 8 by 2. So effectively 4%. So now this is how these information we have. And in this case, your maturity period is of 4 years. Now what we are going to do, we are going to calculate duration. So as I said, this is semi-annual, so your T will be changing by half. So this is your T, time period T. Cash flow 5% into 100. Sorry, 5% into 1000 face value. So face value 1000. So $1,000. So in that case, these are going to be your cash flow, and at this time period you will get 50 as interest and 1000 as maturity value, and that's why 1050 you have in the 4th year. Now, so this is how we are calculating your value, initial value, and this is basically your representing your your what we call it, this is your present value of this bond. Present value, how we calculate. We calculate present value of bond is present value of your interest that you are going to get plus present value of your maturity amount. So when you discount all these series, all these cash flows, you will get this. So this is basically your present value of bond. And now here what we have is cash flow. This is your cash flow. Cash flow means your this amount, this 48, and this is your time weightage. Remember, so 48 into half, it becomes 24 0.04. So this is your cash flow. So here this is each time period discounted cash flow. We are multiplying it by time and then calculating it. So once we calculate, we are getting duration as 3.42. And if you compare this duration with maturity, so your duration is coming 3.42, whereas bond maturity is of 4 years. So what it is saying that your on time, using the time value of money concept, you are able to recover your initial investment in 3.42 years. But your bond is still having some life, or is still bond is of 4 years, right? So it means when you know duration, you know when you are going to recover or when you are going to get your investment back. And where you are going to, where this kind of duration concept is going to help you. Duration will help you to match your, liability with your, investment duration. So why I'm saying, let's say, there is a company and company requires a kind of payment of 10 million after 10 years. And company is thinking that what I should do, so that I should have what kind of investment I should make, so that I should have at least remember, at least 10 million available in 10th year, right? So in that case, what company should do? Company should try to invest. So in this case, effective duration is 10 years. Why effective duration? Because you are or company having certain liability in 10th year. So company effectively knows that whatever investment I'm going to make, or as a manager you are going to take for your company, that should have a duration of 10 years. So you need to select your investment. It could be, you can think of 10 year for getting this. Let's say you go for a mix. Let's say you purchase one 12-year bond, you purchase on another bond 15-year, you purchase 20-year, and when you calculate your duration, you know how much it is. Let's say 40% you invested here, then 30% your wealth in another two. So using this duration, you will be able to estimate how much you should invest and whether your investment will exactly match your liability or not. Because these maturity are different, but when you calculate duration will exactly tell you what is the effective maturity when you are going to recover your investment. So if when you are going to read your portfolio theory, there is a term we call it portfolio immunization. Portfolio immunization. Immune, it is coming from word immune. So what it is saying, generally, when companies are going for this investment and having some kind of liability, they use this understanding of duration concept, and they create portfolio accordingly, so that the year when they have the company having liability, they will have enough wealth or capital to meet that obligation. So in portfolio immunization, role of application of duration, you will find. So you can read it. There are various sources, but in this course, I'll restrict my discussion only up to the basic part. Advanced part, of course, you can read it in your other courses like portfolio theory or fixed income securities. If you pick, definitely these things are going to be discussed. So this duration part is clear, how to calculate. Any question? Anyone? If you have any question related to duration, we can discuss. And so now here, now can you calculate duration for all these three type of bonds? Students, you take time, you take 10 minutes, you calculate this, these duration for these three different bonds, and then we'll discuss. And this is very easy. So even if you want, I can show you this table. Yes. So I'm expecting that you are going to solve this problem, and then we will come back and discuss whether you are able to calculate it or not. So in first case, you see your face value is 1000, coupon rate 12%, and payment is semi-annual. In second case, it is 10%. Your required rate of return or interest rate is 10%, and third case 8 and 10%. So can you solve? And I need at least 4 students so that we will be able to decide whether you are able to calculate correctly or not, the way we have done in yesterday's session. And if you want this formula, so formula you can note it down. And once you are done, you can raise your hand. So I'm waiting. So you calculate at your end, and then we'll discuss. Any one of you are able to at least calculate first one? Yeah, Karthik V, are you there?
Yes, sir. I'm calculating, sir.
Okay. Mukul? Deep?
Calculating, sir.
Okay. So you remember your weight is basically cash flow divided by present value of your bond. So if cash flow in a given year divided by your value of bond is weight into T, you have to do. So weight in a given year into time T, that is small t, and then summation of that will give you your what we call your duration for particular bond. And once you are done, you can raise your hand. So once we see four students, at least four or five students, they are able to do, then we'll discuss a solution. Any one of you are able to do this problem? At least out of these three, anyone? So remember again, I'm telling you your duration. Your duration is nothing but weight into T. T is equal to 1 to N or whatever is there. And your weight is what? Your weight is basically a cash flow in a given year. So CFT divided by sigma T is equal to 1 to N. CFT divided by 1 plus R power T. Assuming here R is, your payment is annual. So here your coupon payment is annual. So if you adjust it, so for every year you need to get weight. You multiply weight with T. T is, in case of semi-annual, it will be half, 1, 1.5, then 2 up to 4, 3.5 and 4. Basically, you will have 8. Sorry, here it is 5 years, so it will go up to 5, 4.5 and 5. So you will have basically 10 terms, and for this 10 term you will have to. It is easy if you use your Excel or calculator. You can also use, and then your summation of multiplication of weight into T will give you duration. So basically, if you look at formula, what formula is saying that duration is function of how you get the cash flows over the period and your type of payment. So it is function of two things: how your cash flow patterns are across the time period. And remember, if you have a bond where all the payments are here in the initial time period and there is no payment here. So it means your duration is going to be less. Or there could be scenario where payment is only here, means in the last year. If this kind of bond is there, so in that case, your maturity will be equal to duration. So we'll take or will also see this kind of problem. But unless you understand how to calculate it, we won't be able to understand these concepts. Because in Excel, you need not to do much. Once you create code or once you create, one table, by changing the coupon rate, you should be able to do it. Anyone who has done at least once, yeah, Pujan.
Sir, can I try?
Okay, yeah.
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 Yeah, sir, for the first, I got duration as 3.946.
I'm writing here 3.986. So this,
946. 46.
okay, so here 3.94, right?
Yeah.
Okay,
Uh,
year.
for the second, 4.05.
Third,
4.8.
4.18.
18.
Yeah. At least it seems your trend is clear. Trend is consistent here. So I'm expecting, Pujan has already done and got these numbers. I'm expecting from others to confirm. And unless we get at least 3 or 4, observations from different student, we won't be able to, decide which one is correct. Yeah, others. Remember, this is very important concept whenever we talk about fixed income or whenever we talk about bonds. So in most of the textbook, especially initial textbook that are written on financial institution and market, they don't go into these duration part. But because most of you may be taking or may have already taken financial engineering, so for those students it becomes very important to know up to what extent bond theories or understanding of fixed income security can be used. So that's why this is, relatively advanced application of bonds in the, towards the portfolio management. And that's why we should know at least basic basic component. And then based on that, whatever course you take in future, you will find it's very much aligned. Otherwise you may find that you have discussed YTM, then about the characteristic of bond, but you don't know what is duration, why we use it. So from that point of view, I thought at least we should discuss more about bond. Yep. Calculation should not take that much time. You all are doing engineering. So in Excel, if you are using Excel, hardly it will take 2-3 minutes if you are clear with this concept. And you need not to, and the like in YTM you will have to interpolate. And in this case, you are not going to do any kind of interpolation or you are not going to guess. You know formula, you need to just input the details. Yeah. Any other student who has done? Yeah, other students.
Sir, I did it, but there seems to be some miscalculation. I'm not getting a proper trend. So
Okay, so
I did.
Anuj, yeah, what number you are getting? You just tell number anyway. We will discuss. Don't worry.
Okay. So sir, first one I am getting 4.5089.
4.5089.
For second one, 4.166. And for third one, 4.277.
Okay. At least we should hear one from one more student, so that who is Pujan's estimation is close to correct one or another one, so we'll be able to finalize. At least any one more student response. I'm waiting. Yeah, any other student?
Sir, 1 minute, sir.
Okay. So in this case, the only difference here we have is in terms of coupon payment, 12%, 10 and 8. Other things are same. And here is how you can do in Excel. So in this case, your duration is 4 years. So in your problem, this is 5 year. Cash flow as it is, you can calculate. And then cash flow needs to be, even this is not required directly, you can calculate this step using your Excel. So basically you need this column, you need this column, and then basically this column. So only 3 columns are required if you are doing in Excel. Even only 2 if you use product sum in Excel function. So if you use this function, even in only these 2 columns will be sufficient for calculation. So if you are done, you can raise your hand so that we can at least in today's session, we will be at least clear with duration concept and its calculation.
Sir, for first one, I got 3.96.
Okay, so you got 3.96. Second.
Sir, I have only done first.
Okay. See, I have already done, so you may want to check it. So Poojan, his answer is close. So I have used Excel. So and I have restricted only up to 2 decimal points. So in case of Poojan, if you see, he has gone up to 3. So here for 12% coupon, duration is 3.95. For 10 it is 4.05, and for 8% coupon is 4.18. So any trend are you observing? Anyone? Are you observing any trend, any relationship relationship between duration and coupon?
Sir, as the coupon rate is decreasing, the time required to recover our initial investment is increasing.
Okay. And any other observation? Why it is happening? Yeah, why it is happening? Your observation is very correct. Like, assuming that your required rate of return or interest rate is constant, increase in coupon reduces the duration. Basically, increase in coupon reduces time required to recover your investment. And why
Sir,
it is, yeah.
sir, if we are here, we are assuming that all cash flows are happening at the same time in time steps, like
Mhm.
half, then one and a half. So, but the cash flow is decreasing if we are decreasing the coupon rate.
Okay.
So if cash flow is decreasing semi-annually, then automatically we have to wait for a longer time to recover that same amount.
And yeah, your point. So I'll make it, I'll take your point and I'll make it, slightly easier to interpret and understand. Here you see we have 6 months, 1 year. This is 1.5, and this is 2 year. So when you have a 12% coupon, remember 1,000 is the face value, so 120. So here in this case you are getting 60 rupee every quarter. Sorry, every semi-annual. When your coupon rate is 12%, and when your coupon rate is 10%, you will be getting 50 rupee, $50 or 50 rupee, whatever conversion we want. So what is happening basically, in case of 12% coupon, you are recovering high cash flow, or you are getting high cash flow. It means you are recovering faster, because duration captures how quickly you are recovering your investment. What is your effective maturity for your investment? And that's why duration, I said duration and maturity both are different items, because this bond is maturing in 5 years, but when coupon is 12%, you are recovering your net investment. Net investment means your principal amount with adjusted for time value of money in less than 4 years. Whereas if when coupon payment is 10% annual, so it takes more than 4 years to recover. And of course, when it is coupon rate, why it is happening? Because you are getting less money recover every time period. And now let's say you have this kind of cash flow. So this is your 4th year or 5th year, and you having only here some kind of cash inflow. So this is your time period when you purchase. This is, and there is no in between payment. So what kind of duration you expect in this case, in this second case? This is what we have here, 3 cases. And what will happen in second case? Anybody can tell? What duration you expect? Let's say there is a bond like zero coupon bond, and which is only paying you at the end of time period, 5th year or 10th year. So what will happen to duration?
The duration will be the maturity period.
Exactly, and that's why when we talk about pure discount bond or zero coupon bond, we say that maturity period is equal to duration. And why I'm saying so? Because if you see all these will be zero, and here you are getting, let's say, 1,000 rupee. So your all the cash flow is happening here, and that's why. And here you have only zeros. So only cash flow you have in the last year, and that's why, irrespective of your maturity period, irrespective of your other legal agreements. In case of zero coupon bond, maturity period will be equal to your duration. And that was the reason why initially I said that your maturity period and duration are different concept, but at some point you will find both are same. And this is the condition, especially condition when your investment is zero coupon bond, your maturity period will be equal to duration. So it means, let's say when you are going to match your future liability with your current investment, so one option you can decide, let's say initially we said that 10 million is your company's obligation or some kind of liability, payment liability in 10th year. So one thing company can do, because interest rate keep on moving up and down. So what company can do? Company can go and select zero coupon bond. Let's say 1,000 face value zero coupon bond. And they can go for, let's say 10,000. They can buy 10,000 zero coupon bond, so that in 10th year and having 10 year maturity. Why 10-year maturity? Because for zero coupon bond, maturity period is equal to duration. So this problem of mismatch between asset and liability. Asset means whatever wealth company will have at the end of 10th year to meet this liability. So matching with firm's liability and asset will be taken care of. But the disadvantage of zero coupon bond, you won't get any additional thing. But whereas when you go and buy, this kind of bond, this kind of, duration bond, you may recover your investment, or you may have enough asset before the maturity. So that's why, when, you are thinking about long-term strategic investment, fixed income securities are one of the, area where you can explore more. And from fixed income portfolio point of view, understanding of duration is that's why it's very important. So I guess in today's session our main focus was on duration and its various relationship with the coupon payment. So I'm restricting my discussion up to this, and next week when we are going to start, we will talk about some additional concept which will help you to better understand fixed income securities. So if you have any question, I can take. Otherwise, we will conclude our today's session. Yeah, any question? Yeah, I think someone has messaged. Okay, I believe there are no questions, so we are concluding our today's session. And next week, and I'll suggest you to please read, about duration. What are the application of duration? Of course, I may not get into the portfolio, strategy or portfolio investment style, but in our discussion, we can spend some time to better understand application of duration. Because then modified duration and then convexity, some additional concept will be covering, but it is better if you know what are these concepts in a very general term, then only you will really appreciate our discussion in the class. Fine, so thank you for joining this session. So we will meet next week. I'm concluding today's session.
Okay, sir. Thank you, sir.
Thank you.
Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir.
Thank you, sir.